The U.S. economy registered weak growth in the fourth quarter, and the Bank of Japan, facing its own anemic recovery, cut its interest rate to negative to try and spur economic activity. It was an historic move, and the BOJ now joins the European Central Bank as the second major monetary policy authority to charge banks for keeping money on account. That's right, if a bank deposits money at the central bank, they get charged for the privilege. It's a way of giving banks an incentive to loan out their cash rather than hoard it. But it leaves the U.S. Federal Reserve glaringly alone with its intentions to hike interest rates this year. Increasingly, it appears to Wall Street that Janet Yellen and the Fed will be doing nothing of the kind.
I think March at this point is probably a pretty low probability. And I think the Fed is taking into account what's happening from other central banks, which are continuing to ease, and that's going to impact the dollar, and that's going to create tighter financial conditions for the U.S.
Fed officials on Friday acknowledged the global developments.
What does worry me are things from abroad, like you said, what's happening in Europe in terms of their economic struggles that continue, what's happening in Asia. But overall, I actually am pretty optimistic about where we are in the U.S. economy, and I think that we can weather some of these storms that out there that are happening abroad.
The impact of weak overseas growth and the stronger dollar are evident in the GDP report, where exports fell 2.5% and took almost a half a point on its own off of GDP. Another big negative, a decline in investment dragged down by a fall off in spending for oil drilling equipment. The one bright spot, consumers, who were weaker than the third quarter but still grew their spending more than 2%. They're a big reason why many economists expect growth to improve this year. The U.S. economy has held up remarkably well, but it could get some help from foreign economies if negative interest rates have their intended effects.
I think this is all pointing to the fact that other central banks are finally getting on the program that they have to create the liquidity that the Fed no longer needs to do for the U.S. economy.
A big Wall Street rally showed investors were content to shrug off the weak U.S. growth and roll the dice on the prospects for better foreign growth and less Fed tightening. For Nightly Business Report, I'm Steve Liesman.